how to go from paper records. So we're going to work on a sample Nigerian company. How will you go from paper records? You know what we mean by paper records. The person is just showing you receipts, showing you payslips, showing you things that are not in any computer and saying these are my records, and then maybe just with bank statement. And you have to go from there to building the general ledger, building the trial balance, building the financial statement. And the good thing is we are going to demonstrate with a company that is easy for everybody to follow along with. So what have I done? We normally use this for our training too. So those of you who have done our training before, you might be familiar with this case study. How will you do for a company that is just starting, right? So let us just together go through the story and understand what it is that we would like to do. So this is the worst case of financial model you will ever need to create. And it's common for those of us who are into consulting. So if you're into consulting, this is something that you will come across in some ways, like the person maybe needs to raise money now and they are suddenly asking him for financial statement, for projections, and it needs to show you what has been happening. So let us together go through it. So there's a company called Niger Limited, right? And that's the name of the company, Niger Limited. It's formed by 4 people, Tunde, Ahmed, Ebiri, and Emeka. They've been long-time friends anyway. So this is how they've decided to do the business around something about Nigerian-made goods. They've seen there is a market for, made in Nigeria. They're going to source for high-quality Nigerian-made goods, repackage them, and supply to supermarkets, right? So let us look at all the things that impact that forms like transactions. They started the business on January 1, 2016, okay? And they started with a cash of 500 million naira. And it becomes equity. So not to bore you, that's all what you're saying. If you are talking to them, they'll be telling you this in words and maybe showing you paper trails. So how are we going to turn all of what they are saying into something like this? How are we going to turn everything that they say into, a journal that shows all those transactions, the legs of every transaction, debit, credit, and if you are still the old school type, you might even want to build a T account out of it, so you're able to pictorially, visually see clearly the asset side, the liability side, the equity side. This is interesting, even though this looks a bit out of comfort for some of us who are not in the finance field. You will enjoy what we want to do because something you can relate with. So this moment. Okay, so this is something that we're going to do together right now. Out of it all, how do you extract a trial balance? And some of you will find this interesting. If you run a business, the way you think about your business is really different from the way financials of the business are meant to be captured. Most of us, when we think of revenue, we think of it as money that we have. If you've made a sale, you expect that the cash from that sale should be in your hands, right? So we're going to show you how you will capture in accrual basis the trial balance that actually shows that sometimes, the expenses you have incurred has to be recorded for the period that you're reporting, not based on the cash that you paid or based on whatever other legal stuff. Your landlord can say, your office landlord can say you want you to pay 2 years rent. But when you're going to report it, it's 1 year rent you will report for a year's analysis, for a year's financial statement. So all of those things, I'm going to show you how it's easily done, and then how you're going to get out the income statement, right? The income statement looks a bit straightforward because the business is not complicated, okay? And that's why I say you will find this really interesting because everything we're going to do are things you can relate with, how you're going to get out the balance sheet, right? And then how you're going to get out the cash flow statement. So without wasting any more time, let us begin. Okay. So just a bit of some theories for everybody who is completely new to the whole concept of financial modeling. So financial modeling is, like I keep saying in all of our webinars, all the previous sessions, right? This is session number 9. There have been 8 sessions before now. And what I keep telling people is that financial model is the representation of a company in terms of its financial. So it's something that your investors, your bank, your co-management team, they can look at, instantly see where the business is. So that's why it carries a lot of weight. And more importantly, as a company, when you are doing your plan and your projections, that becomes the basis of your forecast into the future, so that you don't have your plans negating themselves. If you leave different departments to plan for themselves, marketing will plan to get sales, but they don't care about our expenses. They don't mind spending all the money they bring in to get the sales. Accounting and financial control, they will be thinking of cutting costs. They don't care sometimes that cutting costs can reduce how the business will be profitable in 3 years' time. They don't do anything new again. Anything that is not making money, they cut out. Whereas maybe what's not making money now is what will generate the big money tomorrow. Right? So you find out that if you leave it to different segments of the company to be doing their own, you're going to have problems. They will do plans that just favor their self, but ultimately might destroy the company. You will no longer have a company if you just execute with their plan. So that's why there's always supposed to be a financial model that captures all the aspects of the company together as one, and that way, we can begin to use that for plans, for forecast, for need to raise money and all. So that's the whole story to financial modeling. That's the whole story I'm going to say about it, so that we can dig into what we're supposed to do today. If you still have some trouble with getting the concept, you can always watch the previous sections. So now let us start with what we have to do, right? I know you say you can see my screen. So if anytime you no longer see my screen, just put it in the chat box or unmute yourself and talk. Okay. So let's start with the transactions as they happen and how we record them. On January 1, the company was formed and they started with a cash amount of 500 million naira. So cash account. So immediately in your journal, you'll have to record that there is a transaction that affected the cash account. And so when cash account goes up, cash account, asset. So when asset goes up, down. So when asset goes up, that's a debit side event, debit side activity. And when it goes down, it's a credit side activity. Okay, so that's why this is recorded on the debit side. Now, and when that cash was used to form the company incorporated at 1 billion naira shares, 50 kobo per share, which means we now have an equity. That money is converted to equity so that means the balancing side is equity. So when you raise money, which you reflect in your bank as cash, which is an asset, and you give people equity, so you raise money 100 million naira as equity on your balance sheet. That 100 million naira is going to reflect as equity, and then in your bank account is also going to reflect, which also means that on the equity side, but when equity goes up, it's a credit transaction. When it goes down, it's a debit transaction. So that's why when I enter it here, you will notice, let me just increase the zoom of my screen. You will notice that it's on the debit side, okay? Then as we go on, this is taken care of now, right? Let me just be highlighting them as we go, so that whoever joins later, we know where we are. So I'm going to highlight that we have done this one now, okay? So let's go to the second event. On January 16, 2016, they bought with cash. So they used up cash. They bought a building at Ikeja, Lagos for 250 million naira to use as office. So now they've acquired a building. They've acquired what in the balance sheet, in the fixed asset side, we'll call plant, property, and equipment, if you want to bundle them together, right? So we used up cash. And remember, when cash goes down, cash and asset now, when it goes down, it's on the credit side. But then one other thing that happened is that that cash that was used up was used to acquire an asset, a property. So there is now this new account type. So if you heard of people saying chart of account, right? A lot of times what it means is that we are categorizing every major category of our transaction into broad categories like what is affecting assets or property related assets, what is maybe affecting payroll. So that way you can be able to do a much more meaningful category analysis. So in this case, what was bought falls under the account asset property. And because you now have more property assets, that's a debit transaction, but you used up cash. So that's a credit transaction. We have already explained that. So when asset goes up, let me just put it here, type. Okay. So when it's an asset, going up means debit and going down means credit. Okay. So now that we have done for what happened on 16th, this is actually 16th of January. We move on to the third one, right? And for the third one, on January 24, 2016, they bought, let me highlight this. Okay. They bought with cash some packaging equipment and set up factory plant for 100 million naira. So that one was building. Now this is a plant that was set up, right? So similar thing, assets, but plant and equipment type of asset goes up by 100 million naira. You use up cash of 100 million naira. So now we are again done with this. Okay? You see that this is really interesting. Some of the things that you used to just see on the books and you never relate to how they come about in terms of the reality, on the layman's reality. Okay, so on January 26th, they bought with cash an inventory of 80 million naira. We all know what inventory means, raw materials that you acquire, right? So if you buy raw materials, so you use them to make your finished product and all of that. So as usual, assets, which inventory is an asset, goes up 80 million naira. Cash goes down 80 million naira. So that one is also done. Then we move on to on the 1st of February. So we are beginning to get to some interesting aspects. Okay. So on the 1st of February, they hired 10 people to make up the company staff. So now you are having staff, and you're going to be paying them a salary of, so all the salary you are paying them all together anyway comes to 8 million naira, and you do this on the last day of the month. So the first payment is going to happen on the 29th of February. Okay, so we need to record that on the 29th of maybe that February doesn't have 29. On the 28th, what if it was not a leap year? Whichever way, anyway. So at the end of the month, right? So originally, this thing was here. So I put it that on the 28th of February, salary is an expense. So the thing is that we capture revenue and expenses differently. So revenue is treated like assets, which means that when revenue goes up, it's debit, and when sorry, forgive me. Revenue is treated like equity because revenue accrues to the equity owner. So when revenue grows up, it's credit, and when it goes down, it's debit. For expenses has a negative effect. If you think about it, you are the owner of the company, what accrues to you is the equity. So when you get more sales, well, that's like good for you. So it follows the thing. But when you get expenses, like you're taking from that money that should have been yours, right? So you see that expenses have the opposite effect. So which is like, when it goes up, it's debit. When it goes down, it's credit. Okay. So maybe what I will do, I will share with you this resource. This is one of the manuals we give people for our training. And I think I have a sheet here that shows all of this. So, and with some stories to help you understand if you are the type who have no accounting background. All right. So I'm going to share this towards the end. So let's continue with where we are. So now when you pay salaries, right? That's 8 million naira that you pay, which means it goes up. Your expense, salary expense has gone up. Up is debit. But cash has come down. You have to take from cash account. That is a credit transaction on the cash side. Okay, so let's move on to number 6. So number 6 is on February. Maybe so that those who join late, they can still see the beginning part. So on February 12th, we recorded our first sale of 15 million naira from an inventory of 8 million naira, and were paid instantly by bank deposit. Now, let's break down what has happened. We made sales. Sales is revenue of 15 million naira. Now, how do we capture that revenue? Now, what's the balancing side of this? The balancing side is, how did the customer pay you? Did the customer pay you in cash, or they will pay you later? So we are lucky in this case, the customer paid us in cash. So we have the balancing side as cash, of 15 million, right? So how do we record this? Remember, when revenue goes up, it's credit. And see, let's for that here. So revenue goes up 15 million naira. That same day, cash too goes up 15 million naira because that money came in as cash. So this part now captured this and this. You see how they always balance themselves. That's why it's a double. So double entry. Then what's the other side? We used up inventory. The inventory that we used up is 8 million naira worth of inventory. So the cost of that sales to us is 8 million naira. So your cost of sales, and so let's say we used up inventory of 8 million naira, which is an asset that has gone down. So asset goes down. So that inventory has gone down 8 million naira. But we have to expense it out. So it's captured as cost of goods sold, which is an expense. So this is like expense that is cost of goods sold. For asset that is inventory went down. So asset that is inventory went down, and our balancing side is expense that has gone up to capture that. And you all know when asset goes down, that is credit. So asset inventory went down, but the cost of goods sold went up, an expense. An expense going up is a debit transaction. And that's how this one captured like that in my mind. Okay, so we're making progress. Let's move on now to if you have any question, you can always type. I can see my screen. And if you want to say something, you can also say. On what now? We are here. So on February 25, they recorded another sale of 30 million naira from an inventory of 14 million naira, but we're not paid immediately by the customer. So there's an issue in this case now. We have a similar situation. revenue of 30 million naira, but we did not get the cash. So that's where something is different here. Customer did not pay us. By accounting standard, once the service has been delivered, revenue is recognized. I've delivered the products to you, whether you are paid or not, to capture it as revenue on my books. But in this case, the customer has not yet paid. So what happens is that it's captured on your receivable, money that you are yet to receive, that you are going to receive very soon. If in a normal course of thing, you should get it in less than a year. In fact, you want to get it as quick as possible. So that's where we're going to put the balancing leg of that 30 million naira. And this one is still the same. Inventory is 14 million. And cost of goods sold is going to be the same. So as you can see, receivable of 30 million, to capture that sale of 30 million, right? The inventory of 40 million used up, and expense as cost of goods sold of 14 million naira. Okay, so we're making progress. Now, every month, the company incurs general office expense. So cleaning, office supplies of 2 million naira, but the expense is paid for in advance on the first day of the month. Just think about this. You need to buy stuff. You need to, things like stock the office with printing stores, with water coolers like dispenser, with things that provisions and some things that need to be used for the toilet, for all those things. Normally you buy a lot of them up front. So maybe on the first day of the month, your office assistant makes sure he procures all these things that will be enough for the entire month, right? So this is a case of where every month, starting from the month of March, it's 2 million naira. Where did I capture that here now? Oh boy, I think I missed that one now. So we're going to write it there ourselves since we already know the pattern of things. So let me just create a spot for that. And for now, I'm not going to color it. I'm going to color it. So starting from the month of March, so on the 1st of March 2016, we incur general office expense. So it's an expense, the type of expense, and G&A, or let's just call it admin expense. Call it office supplies, so that it's a bit more granular in chart of account. Okay, so office supplies. And when expenses go up, what do we say it impacts? When expenses go up, that's a debit transaction because it is reducing from what available for the owners of the business, right? It's reducing what you as equity owner get. So that means 2 million naira here, 2 million naira. Now, what's the balancing side? So I didn't state it here, but let's say that it's paid off from the cash account because that's usually normal. Except you have a contractor that supplies you. If your staff needs to go and buy them from different suppliers, different supermarkets and street sellers, I think those ones will give you credit. Then. So you find out that cash goes down. When cash goes down, which is an asset, that's a debit. I mean, that's a debit transaction. Remember, just always keep watching here. Okay, so that part is now captured. Okay, and one other thing that we try to do is to make it easy to read. The ones that are like credit transactions are indented. Again, in real life now, because you'll be using software, QuickBooks and all of that captures this automatically for most of you that you already have accounting to, or if you are working for the contract, you're a consultant and you've already set up those things there, well, you will not need to worry too much. That's why I say this is the worst case scenario. This is where the company has not been using a proper accounting software, and now they are having to tell you in where all that is happening and showing you paper transactions. All right, so we are now where now. We have done this office supply, so let me just mark that this is done. So we move now to number 9. Okay, so starting from March, right, the company began incurring monthly telephone bills, internet bills, electricity bill, water bill, utility bills that total 1 million naira, but they are paid on the 10th of the next month. So there is a kind of postpaid. If you still use postpaid, like your NEPA stuff, PHCN, which means the what you use for July. All right, well, at least you can see my screen, so I can continue from that place where we stopped. Okay, scrolling now, but it's taking time to render. Okay, good. All right, so I'm going to, wow, this is something. All right, so I'll be a bit faster to finish off from this part where we were at number, the person that owed money paid back, right? So that's number 10. So on March 5, we got back the money that this person we sold the 30 million naira worth of goods to. We got back his payment. We got his payment, and that is going to be reflecting. Okay, good. So I think things are back to normal. So that's going to be reflecting here. Okay, and then the number 11 is you took a loan. So you took a loan. The business took a loan of 300 million naira from Zenith Bank to be paid over 6 years with a bi-yearly payment, so twice a year payment of 30 million. That will be split into 3 million to cover. Let me just explain it in a very easy for us to understand. We took a loan of 300 million naira. So that means we have a new money that comes in as loan. So under liability, 300 million naira. But because we are giving that money as cash, so cash will be the balancing side. Okay. Then for that loan that we took, this is how the repayment is meant to be structured. So because of time, let me just start showing you. We've done this one, on this. Then this is that loan I mentioned, right? So it's the interest side of it we need to go and capture. How we're going to start repaying that loan, So for that, the repayment part, the first one is going to happen in the next 6 months. So 6 plus March, like 6 months after March is going to be like 9 September. So if you go down, you'll see where I've captured it as it's taking too long. I'm saying here, interest expense. So it's August. So you see that every 6 months we need to service the loan. So it's expense out as interest expense. So we are servicing with 3 million naira interest expense every 6 months, and there's going to be a 27 million naira principal repayment also. So we capture the interest expense, the principal repayment, and all of that impacts the cash. They are coming out directly from the cash account. Okay, so that's how we capture every 6 months. You go and start capturing that again. So the next 6 months, it will happen again. Okay, so that one is captured. Then on that's this one. Then on April 12, 2016, the company struck a deal with ShopRite to supply products of 100 million naira on 15th of every month, starting from April. So again, it's a very straightforward thing. If we start unpacking all these components individually, what is happening is that we are going to be making a sale of 100 million naira to ShopRite. Fortunately, they are leaving the country. And it's going to be happening on the 15th of every month. We're going to supply them across their chain of supermarkets, and they're going to pay us back 30 days after. So which means all this money is going to go to receivable, right? And as usual, we have to capture what inventory was used up. What inventory was used up? So inventory used up is 35 million. And we're going to always expense it as cost of goods sold, so 35 million. Okay. And okay. So this one we already know how to capture. It's similar to what we've done before, and that's what you're looking at here. Revenue. So convention-wise, we like to do the debit side first. That's why you will notice I'm always consistently doing the one that is the debit side before I express the ones on the credit side. It's just convention that no longer with software now, nobody follows this convention anymore. But it's good if you're coming from the academic standpoint of interpreting this on paper. It's good we still follow the convention anyway. So the cost of goods sold, the inventory, right, captured, and we move on to, so every 30 days after, something is going to happen. We're going to have the receivable go down and cash, because that 100 million naira that is in receivable will be now become 100 million naira that is in cash because the customer has finally paid. So if you look at this now, exactly 30 days after, which is this, I have done that capturing. So you always have to ensure that everything is captured. Okay, so that one is done. Then let's go to number 13. Okay. To support sales, the company partnered with a key supplier of its inventory to supply inventory worth of 35 million every first day of blah blah. So again, if we unpack it, we are getting inventory worth of 35 million from our supplier, right? So which means we are supposed to pay them. Normally you're supposed to pay them with cash. So let's see how we paid them. We decided to pay them 45 days after. So which means it will become payable. In our account, it will be captured as payable, right? And if you look at it, where is that? Which date is that now? On the first day of every month. So that's going to start happening from June. Yeah. So it start happening from June, first day of every month. So that's the number 13 now captured. Okay. So let's move on to number 14. On December 31, the company declared dividend of 60 million naira. So dividend is something that impacts equity. So dividend is when you take out from equity, right? So it's a kind of equity transaction. So 60 million, and it impacts cash. Let's say it comes out from cash, not loan. Okay. So that happens on the last day of the month. Where is that? Last day of the year. So there's a bit of jumping around now. Okay. So that one is done. Then company income tax will be paid next year at 20 million naira. And the assets are supposed to be depreciated at 20. So this one, you will see how we're going to capture them as we go on, because right now, up until now, we've not done our stuff on an accrual basis, so it's not going to be captured yet. But all the other lines are the things that are repeating. So if you see the things we have not yet highlighted, these are the things that are, this one, if I like, this is when that 100 million naira came back. Now you see, this is that every 15th of the month, the goods we supply to ShopRite. You see, this is it. Every 15th of the month, the goods we supply to ShopRite. The goods we supply to ShopRite, which is that number 12 stuff. The goods we supply to ShopRite. The goods we supply to ShopRite. The goods we supply to ShopRite. The goods we supply to, okay, how many days? After 30 days, the money used to come back to us exactly 30 days. So let's go and capture it. So the money comes back to us 30 days after. Where is that 30 days now? Starting from when did we start that activity with them? From April. So the first one is going to be in May, 30 days after. Yes, that's captured for May. The next one is going to be in June, 30 days, that's captured. The next one is going to be in July, 30 days after this one. The one after that is going to also be in, so let's just keep capturing all those 100 million naira that comes back as cash after. So by the time we are done, you will see that every transaction is now being captured. Apologies, I feel instead of just rushing it and you not getting it very well, it's better I take more time. When I'm doing the video, I'm going to cut out all the problems we have. Maybe that is now to the advantage of those who did not join the live class. Well, at least now I understand things a bit more now. So when internet, there are about 4 of us, no, 3 of us, and like 5 devices connected to the internet and trying to monitor this. So I think it sucked the bandwidth and affected it. But I was expecting it to just tell me internet is slow or it should be blurry, not that you hear my voice and you no longer see my screen. So we've captured all of that. So what are the recurring things? Salary. Let's see. So salary is being paid on the salary. It's being paid on the 28th of every month, right? So let's see. Or on the last day of every month. So salary, last day of every month. This again is salary. So I begin to see that everything is getting colored out now because we're eventually capturing every transaction. The ones they tell you, oh, every last day of the month we buy this, or in this case we pay salary. So this is it. This is it. Salary. Please, anytime you no longer hear me, please let me know on time. It will have been crazy. It will have been crazier if maybe I didn't even, nobody notified me. At least you notified me and we struggled it out rather than me just talking and thinking you are getting what I'm saying. The salaries, salary, and salary. So what other thing is recurring? We pay utility bill. So we pay utility bill when? On the 10th of every month. So let's start tracing down. 10th of every month, utility bill. See, by what happens is I type them out, but because if I say I should be typing them as we are in a webinar like this, typing, everybody can type. So it's better I show you one by one and maybe share this file with us rather than just typing. There's nothing special about typing. So that was why I took my time to explain the initial leg of those, initial recording of those transactions. I think we've captured all of the utility bills, 10th of every month. So what other things are always happening? Our supplier that we buy something from, we always pay the supplier 45 days after. So 45 days after, support sales, blah, 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 okay. So we always pay them on the 15th of the next month. So on the 15th, starting from June. So where's June? This is one of those ShopRite sales. And this is that one of so yeah. Starting from so this is one of those our supplier that will pay back 45 days after. So what we bought in in the middle of the month, where is that stuff? So what we bought, we are paying back anyway. So let's start looking for the 15th of every month and saying what we paid back. So 15th of every month, we pay our supplier, pay the supplier. In real life, it might not be the exact amount, but it's once you get the concept. So this month, we might buy 35 million worth of raw material. Next month, we might buy 100 million. But this is me capturing that time that we pay them. So it goes from payable to cash. So I think that is done. I think that's the only transactions. Those are the transactions that are left. So you see everything is now colored. Like we have captured all of the activities that has happened for this company that they tell you with mouth and give you final a bank statement sometimes to track what the actual amount involved was. Finally. So this part is now done. Once you've captured now in a kind of double entry journal, all those transactions. We will not talk about T account because it's so old school. Before, in the olden days when all these things were done on paper. So we used to now, well, they used to because I didn't do this anyway. So they used to have to create a much more visual way so that you can see all the transactions that happen to the cash account. So everything that happens to cash, cash is all your chart of account anyway. So you just come here, create, that's why it's called T, it has a T shape, right? So you write all the different debit legs, the credit legs, and for cash is always, by the time we want to do the transformation, you will have to find the final difference, the closing balance, and put it on the debit side. But the good thing is with all the software we use these days, nobody does this. Even with Excel, I don't need to do this. I can directly just go from here to my, even the general ledger is done in such a way that looks a bit more like this tabular form. Okay. So the only difference is just that general ledger just keeps showing you all these transactions as they happen in a tabular form. Whereas trial balance, we go and sum up what the final value is. So if I knock this part off actually, and I put the date for all the transactions, that will be my general ledger. If I take all these transactions that has happened here, and I arrange them in this tabular form with the date, then that is the general ledger. But here I didn't, when I was building this one in class, I did the T account style. But nowadays, this is what everybody does. So if you have all these transactions in this tabular form with the date of when this one happened, when that one happened, becomes a general ledger. But when you begin to now take out the chart of accounts, you take out every category and you total what has happened. What is the total that happened to cash, total debit, total credit, total, all of that happened to cash, right? Then the final value becomes what you use for your trial balance. So there's just a bit of, so I'm going to increase this one, the zoom. There's a bit of, let me see if I can just do them for us a bit. Let's do some. Let's not do all of them so that you get the feel of it. Let's do some. So cash, what's the final value of all the things that happen to cash account? If I come here and I sum up, all the debit, all the credit, and make the credit to have negative and the debit to have positive, right? the final value I will come to will be for cash account. This is the final value. When I add up all the credit, debit, add up all the credit, do the debit total. Okay. So that's what you see that I've put in here. Because of time, I'm looking at my time. I don't want to recalculate that. So just remember that the ending value are by the account type. So cash, the total value on the debit side, because it's debit total. Remember what we said here. Maybe I should just put the total like. So asset is debit total, equity is credit total. So the total side of it is always the upside anyway. So when you are totaling them, it is what is reflecting eventually in the debit, credit, so that things will balance out in the end. And that is what I have done here. So you see all the assets are debit total, all the liabilities and equity are credit total, and then the expenses are debit total. So you get the pattern. And if you don't follow that pattern, you will never see that these figures will not match. So that's why it's called double entry. If you follow those convention correctly, things will go well. All right. So for nowadays, for the trial balance is the final value. So these are more like for me showing you the breakdown. But whenever you spool your trial balance, it's always the ending balance you will see, right? So it's this ending balance that we are going to be using to create the financial statement. The only different thing is that this is done as if, so when people tell you their transaction, they always say it as if it's cash based. It's done. Okay, let me cancel it. It's not reflecting what we call accrual based. In terms of the timing is not capturing the accrual, that this thing that has happened there. Just because you paid for something now does not mean you recognize that money as now. If I pay for 2 years rent, I'm only going to recognize here the money I paid that covered this year. So that's what we are going to do. We're going to adjust the trial balance. Again, if you use a software, a proper accounting software, they will have been set up like our QuickBooks. I can't log into it because of confidentiality, but it's already set up for us to enter those accrual stuff right from the get-go, so that you will not have to be manually adjusting. But if you are doing for someone who is giving you paper and bank statements, you will be the one that will do this. So that's where this kind of information comes in. So what is the tax that is due for that year? So the tax expense for that year, even though we will not pay that tax until next year, because that's when we will eventually pay it. In fact, when you pay, the value might be different. But it has to be recognized in that year. Okay, so that's this. So now you see how we capture this. So this is the basis of that accrual. We are adjusting your trial balance to work in line with accrual basis. So that's what will be used to build the income statement. Similarly, all our assets that we buy, so all the plant equipment and all those capital assets we buy, we always have to take out the depreciation expense. Again, it's another kind of accrual concept anyway. So the depreciation, okay. Then if you remember, there are some expenses that we incur that we don't pay until the next month. Utility bill. So that means that utility bill for December, because of this way we have been taking it, what you use up in December, you will find out that it's until January that you will end up paying for it. So if you look at it, there's nowhere in December that says that we paid utility bill. But we are going to incur it. You will even see that for November, the utility bill that we paid is not actually November's utility bill, it is October. So what do we do again? We have to adjust this to reflect that the utility bill for December too has to be added. We have to make sure that the utility bill captures for the entire reporting period. So that's why I say it's not tracking it's following when you use up that expense or you incur that particular transaction. And the other thing is also some other expenses. So apart from utility bills, there are some other expenses that all right. So the expense that you incur that you have not yet paid for, so we call them accrued expense, right? So all of that. What's all that thing? If on just that our payable, do we have anyone any expense related again? So that's the only thing. Okay, so every other thing is already captured properly. Just accrued expense is what if you have any prepayment. So let me just use the terms that are always captured. Prepayment. If there's anything you have paid for that you have not yet enjoyed, you have to, if there's any expense you have incurred that you have not paid, and then things and tax has to be recognized for that you have to properly do the income statement. So right now, we're going to do the income statement. And income statement is the easiest part. You know why? For income statement, the lines you need are purely just revenue and expenses. So these are the charts of account, the categories of account that you need to create your expense, your income statement. All you need is just revenue and expenses. And if you think about it, let's start looking at what falls in revenue and expenses. This is an expense. This is revenue. This is an expense. 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 So you'll find out that in the end, these are the things I'm going to. So if you notice, I have relabeled them a bit here to be more transparent, and that is all what we are using here. So if you remember my trick of how I can show two sides of my Excel at the same time, if I go to view menu, and I do new window, right, it will allow me to have two copies of the same Excel, and I can put this one here, and I can put this one here, and I can take this one to this, and we can compare and contrast and see that revenue, this is it. The final value of the revenue comes here. Okay. Cost of goods sold. So cost of goods sold. So you notice that they are just the revenue and the expenses we are using. And gross profit is that minus this minus that. So this person now, his account is coming out from paper and words. We are already creating his income statement. Operating expenses are now all of these salary, utility, general and admin expenses and marketing expenses, you know. So in our balance, you know, SG and A make up the operating expense. And sometimes to make it easy for you to create your cash flow, I sometimes like to have depreciation separately. Okay. But if you're following IFRS standard, you will leave the depreciation that is for operating expense inside here. The depreciation that is for cost of goods, so you leave it inside there. But still, you will have to take it out eventually when you want to do your cash flow. So a lot of times for internal reporting, it's always good that you even separate them out. You will just be like cost of goods sold depreciation, operating expense depreciation. Anyway, I bundled them and separated them out as one line here. Okay, so that's the depreciation expense. Okay, and then the interest expense, you know, what you use to service your debt. That's from there we're able to get profit before tax, and then what is the tax expense, which is like a percentage, usually like maybe 30% of this, but for sake of making things easy, we are just going with an absolute figure for now. Okay, So now that we are done with the income statement, let's see how we get out the balance sheet. Now for the balance sheet is everything. Use everything on the entire balance. Do the balance sheet actually. So let's go to see how we get out the balance sheet. So this is the structure of the balance sheet. Again, you can watch our past recordings to get a reminder of this. And cash and cash equivalent is it. I want to make everything show on the screen. Let me reduce this size, so that visibility will be better. Okay. All right, so cash and cash equivalent, accounts receivable, I'm just bringing them from there, inventory, and from there we get our current assets, right? Then the plant property and the fixed assets, right? So plant property and equipment. So again, I'm dragging this. Then to get the net book value, you have to take out the depreciation. So less depreciation, so that we are able to get the net book value. Okay. And if you have other assets, so most small businesses will not have a complicated balance sheet. So they might not have intangibles, they might not have long-term receivables. So we move now to the current asset side. So what do we have as loan? In fact, let's start with the current side. What do we have as like short-term loans? This company does not yet have anything there. What do we have as payable? This is very common for all small, medium-sized, non-complex companies. So payables, again, we'll bring it. Then what are the accrued liabilities? What we owe that we have not yet paid? So that's like that utility bill. Then deferred tax. So that's that. Though this one is more like tax liability. We are not supposed to call it. If you are following strictly the IFRS very well, this will be the right word. So this is what we are supposed to pay that period, okay? Until when the account is reconciled and we have exactly what we are supposed to pay. That's when we'll net them off. And then some things will now move eventually to the deferred tax liability in the long-term side. So I don't want to confuse us with those ones. For now, until we get exactly what the tax is, this one will still be tucked in here a bit until it will now be transferred to that side. And so long-term loan, right? What loan we took, the outstanding balance of that loan, where is the loan side? So the loan, the final figure of the loan that we borrowed, if you remember here, we talked about how we are repaying 30 million out of the 300 million. So once you have repaid 30 million, it means you'll be left with 270. So we are repaying 27 million out of the every 6 months. So that's why if you look at it, you will see that it's less from the 300 million is less 27 million. Remember, on March 15, we took a loan and we are repaying principal of 27 million. So that is why here the net book value is 2. But the good thing is once you have done all those add up, that's what we will have gotten. Once we have done the add up of all the things that happen to loan, you will see that that what I'm saying is the loan side. You see that this is how we know that this is the final value that we are left with. Okay, so I'm going to share this sheet. Just make sure you join the community so that you get the email. And so we have our total liabilities, and the company is a simply structured company, so no preference here. This is that equity from the ordinary shares. and then no revaluation reserve yet, no additional paid-in capital, no treasury stock, nothing has been earmarked for some people and stock away. And then the retained earning is going to be, there's a formula for it. Let me see where we took that out from this place. Anyway, it is what we had last year plus the profit this year. So if you look at the profit this year, it's 367 million. But because this is our first year of operation, so that means that's the only thing we have been retaining. If we pay dividend will come out from it. So you see that this is that dividend we pay. Okay, so in the end, you have your total, and as usual, if you do your balance sheet check, the asset is always supposed to equal the liabilities plus equity. So this is it, right? And the last part is just the cash flow. Cash flow, once you get all those ones done, cash flow, some people find problem with cash flow, but maybe because I do it a lot, I almost like this year now, I've done financial models. I was done for 4 companies, different companies, and that is minus training and minus just for play one, real one, 4. So because maybe I do it so frequently, I've gotten a good hang of it. So I don't usually have problem with cash flow. Places that when things don't go wrong, sometimes maybe here that I didn't do some formulas correctly, or in my debt schedule, all these cash sweep used to sometimes cause circular references. So, but cash flow is very straightforward. That is what I just wanted to point out, especially for a simple business. You find out that cash flow from operations, is purely the profit minus non-cash transactions. So this depreciation is not a cash transaction. It's just something you are doing based on accounting standards to spread that capital expenditure. So again, we take out non-cash transactions. We adjust for movement in working capital. So changes in inventory, changes in all of that. So if we adjust for that, so you will get our net cash flow. Okay. I did not include that line here explicitly, but normally it will be included here explicitly, as changes in working capital. Which is normally, let's just do it together. It's not difficult to do. For receivable, it will be, what you had last year minus what you have this year. Okay? Then plus inventory, what you had last year minus what you have this year. Plus, we go to the current liability, what you have this year minus what you have last year for payables, plus accrued liabilities, what you have last year minus this. And like I told us, usually by the time your books are audited, you will have been done with these tax liabilities stuff. Like this will no longer, the tax will not be showing in an accrued side. You will have known what exactly you pay, so you will have known what is the tax expense and what is the actual tax that the government bills you on. So, but for now, let's just go on with things as they are. Okay, and you see this one does that. Okay, any other thing, this business is straightforward, so they don't have any other funny things that are in their current asset and current liabilities. So for cash flow from investing, those are the capital expenditures. So how much did you spend on your capex anyway? So plant, property, equipment. So if you look at them, all this PP&E, by the time you add them all together, you see it equals 350 million. Okay. Okay, so there are expenses. Did you dispose assets? No. Did we invest, put our money in any long-term investment? No. Okay, so that one done. And then loans for financing, any loans we raised minus the repayment. In fact, it's the net book value sometimes, but it's usually for visibility sake, we show what we pay and then we show what was repaid, portion that was repaid. Then what happened to the equity side? The dividend, did we raise new equity? Are there any other financial for raising stuff we did? No. So in that case, this is the total. And if you look at it, you find out that we now have a net cash flow of 283 million. So this is how we do the cash flow statement and all of them. So thank you very much. Thank you for bearing with me. This is a lecture session is dedicated. No other people are saying Teams can be funny. It doesn't like sharing. So any question on what we've done so far so that we can prepare for the Excel. So right from here, it will be the Excel we will do. And we have a community. Just share the community link. So we have a community that if you are part of, you'll be able to hear the recording, get announcements on that, letting you know of the sessions and how to join. And the recording, at least the edited recording of this, you will also get. So join the community. Any question before I say bye-bye at this stage? Thank you very much to everybody for staying this long, guys. I appreciate your patience and those that guided me on how to overcome this problem. Thank you, Adibare. Thank you, Kazim. Thank you to everybody. And hope to see you next week. If you are interested in the Excel one that will come up, so we're going to have another session on Excel in about 30 minutes time. If you're interested, I'm going to share with you the community link. You can join. And it's also for Power BI. So if you're interested in the Power BI one also too, let me grab you the community link. For the Power BI class. So once again, thank you and see you next week. Have a nice rest of the weekend. Thank you. Bye-bye.